Good morning. My name is Dr. Deepika. Today I'll be discussing about the different types of ratios. Basically, we have four type of ratios, that is liquidity ratio, leverage ratio, activity ratio and profitability ratio. Ratios, their objective and limitation that I have already discussed. Today I'll discuss the basic definition, what do you mean by liquidity ratio, leverage ratio, activity ratio and profitability ratio, and what are the basic formula and why these ratios are used in the organization, what is the basic importance of these ratios. First is liquidity ratio. What do you mean by liquidity ratio? Liquidity ratio measures a company ability to pay off its short-term debt as they become due using the company's current or quick asset. Liquidity ratio includes current ratio, quick ratio, asset test ratio and working capital ratio. Basically, we have different types of liquidity ratio, which I have already explained in my previous slides. Current ratio, which is also known as working capital ratio, quick ratio or asset test ratio, cash ratio or cash asset ratio, absolute liquidity ratio and net working capital ratio. First is current ratio. What do you mean by current ratio? This is the part of liquidity ratio. What do you mean by current ratio? Current ratio is the measure of company's ability to pay off the obligations within the next 12 months. How the company will pay their liabilities in next 12 months. This ratio is used by creditors to evaluate whether the company can be offered short-term debt or not. It also provides information about the company's operating cycle. It is also known as working capital ratio. And the formula to calculate current ratio is current asset upon current liability. And what is the ideal situation of current ratio? It means a higher current ratio around 2 is suggested to be ideal for the most of the industry. It means 2:1. It is the ideal ratio of current ratio. While the lower ratio is less than 1, it indicates the firm having difficulty in meeting its current liability. It means if the current ratio of the company is 2:1, it means the firm's ability of meeting its short-term obligation is very good as compared to the company who is having less current ratio. Next is quick ratio or asset test ratio. Quick ratio is also known as asset test ratio, is used to determine whether the company or a business has enough liquid asset which are able to meet instantly converted into cash to meet short-term dues. It is calculated by dividing the liquid current asset by current liability. So this is the formula. Quick ratio is equal to cash plus marketable securities plus account receivable upon current liability. The ideal ratio is 1:1 for the financially stable company. It means if the company is having the ideal quick ratio less than 1, it means the company's financial stability is not good. Next is absolute liquid ratio. It means a cash ratio is measure of a company liquidity, in which it is measured whether the company has the ability to clear off debt only using liquid cash. Liquid cash means cash and cash equivalent like marketable securities. It is used by the creditors for determining the relative ease with which a company can clear short-term liability. And the formula of absolute liquidity ratio is cash and cash equivalent upon current liability. Next ratio is solvency ratio. It is also known as financial leverage ratio. Solvency ratio basically compares the company's debt level with its asset, equity, earning to evaluate the livelihood of the company, staying afloat over a long haul by paying off its long-term debt as well as interest on its debt. Example of solvency ratio includes debt equity ratio, debt asset ratio, interest coverage ratio. So first solvency ratio is debt equity ratio. Debt equity debt to equity is one of the most used debt ratio. It is also represented as DE ratio, debt equity ratio. Debt to equity ratio is calculated by dividing the company's total liability with the shareholders' equity. It is represented as debt to equity ratio. It means long-term debt upon shareholders' fund, or the other formula is total liability upon shareholders' equity. And the ideal ratio, the ideal debt equity ratio is a higher debt to equity ratio is associated with a higher risk for using or for the business, as it indicates that company is using debt for fueling its growth. It also indicates low solvency of the business. Next is proprietary ratio, and the other name is equity ratio. This is the second ratio of solvency ratio. Proprietary ratio is also known as equity ratio. It establishes a relationship between proprietor's fund and net asset or capital. It is expressed as equity ratio, shareholders fund oblique capital shareholders fund. We can write shareholders fund upon capital or shareholders fund upon total asset. This is two formulas to calculate proprietary ratio. Next is interest coverage ratio. Basically, what do you mean by interest coverage ratio? Interest coverage ratio is used to determine whether the company is able to pay interest on the outstanding debt obligation. It is calculated by dividing company's EBIT, earning before interest and tax, with the interest payment due on debt for the accounting period. It is represented as interest coverage ratio is equal to EBIT upon interest on long-term debt. EBIT is earning before interest and tax, or the other name of EBIT is net profit before interest and tax. And what is the ideal interest coverage ratio? The higher coverage ratio is better for the solvency of the business, while a lower coverage ratio indicates debt burden on the business. It means the company who's having their interest coverage ratio higher, it is better, the company's solvency condition is better. But if the company's interest coverage ratio is lower, it means it is a burden for the company. Company is having debt burden, the company's solvency condition is not good. Next ratio is profitability ratio. This is the third ratio. These ratio convey how well the company can generate profit from its operation. Profit margin, return on asset, return on equity, return on capital employed, and gross margin ratio are all example of profitability ratio. So there are few types of profitability ratios which we will discuss, that is gross profit ratio, operating ratio, operating profit ratio, net profit ratio, return on investment, return on debt worth या net worth, earning per share, book value per share, dividend payout ratio, price earning ratio. So these are different type of profitability ratio which we will discuss in our next slides. Next is gross profit ratio. Gross profit ratio is the profitability ratio that measures the relationship between gross profit and net sell revenue. It means gross profit basically measures the relationship between net sell of the company and the gross profit of the company. Basically, all the profitability ratios are expressed in percentage. So gross profit ratio is expressed in percentage, and it is also known as gross profit margin. And the formula to calculate gross profit ratio is gross profit upon net revenue from operation multiply by 100, because it has to be calculated in percentage. And the ideal gross profit ratio is the fluctuating gross profit ratio is indicative of inferior product or management practice. Next, operating ratio. Operating ratio is calculated to determine the cost of operation in relation to the revenue earned from the operation. The operating ratio is equal to cost of revenue from operation plus operating expenses upon net revenue from operation multiply by 100. Next, operating profit ratio. Operating profit ratio is a type of profitability ratio that is used for determining the operating profit and net revenue generated from the operation. It is expressed as a percentage. We express operating profit ratio in percentage. Operating profit ratio is equal to operating profit upon net revenue from operation multiplied by 100. And the other formula of calculating operating profit ratio is operating profit ratio is equal to 100 minus operating ratio. Next, net profit ratio. Net profit ratio is an important profitability ratio that shows the relationship between net sale and net profit after tax. When expressed in percentage, it is also known as net profit margin. So net profit ratio is equal to net profit after tax divided by net sales. And the other formula of net profit ratio is net profit ratio is equal to net profit upon revenue from operation multiplied by 100. So what is the basic use of net profit ratio? Net profit ratio basically helps the investors in determining whether the company's management is able to generate profit from the sales and how well the operating cost and cost related to overhead are obtained. Next is return on capital employed or return on investment. Return on capital employed or return on investment is a profitability ratio that measures how well a company is able to generate profit from its capital. It is an important ratio that is mostly used by investors while screening for companies to invest. It means this ratio is basically used the company want to invest in any of the project and which project is best. Investor screening is done in which project investor should invest. So this ratio is helpful in that. And the formula of return on capital employed or return on investment is equal to EBIT upon capital employed multiplied by 100. What do you mean by EBIT? EBIT is equal to earning before interest and tax or profit before interest and tax upon capital employed. Capital employed is total asset minus current liability. This is capital employed, the formula of capital employed. Next is return on net worth. It is also known as return on shareholders fund or return or on net worth. This is one of the same thing. We can say return on net worth and the other name is return on shareholders fund, and it is used to determine whether the investment done by the shareholders are able to generate profitable return or not. It should always be higher than the return on investment. which otherwise would indicate that the company's funds are not utilized properly. The formula of return on net worth is equal to profit after tax upon shareholders' fund multiplied by 100. And the other formula is return on net worth is equal to profit after tax upon shareholders' fund multiplied by 100. Next, EPS, earning per share. Earning per share is a profitability ratio that measures the extent to which a company earns profit. It is calculated by dividing the net profit earned by outstanding shares. The formula of earning per share EPS is equal to net profit upon total number of shares outstanding. It means having higher EPS translate into more profitability of the company, and if the earning per share is low, it means the company's profitability condition is not good. Next is book value per share. Book value per share is referred to the equity that is available to the shareholders divided by number of outstanding shares. The formula of equity fund is shareholders fund minus preference share capital, and book value per share is equal to equity shareholders minus preferred equity upon total outstanding common shares. This is the formula to calculate book value per share. Next, dividend payout ratio. Dividend payout ratio calculates the amount paid to the shareholders as dividend in relation to the amount of net income generated by the business. It is calculated as dividend payout ratio is equal to dividend per share upon earning per share. Next, price earning ratio. This is also known as PE ratio. It establishes a relationship between a stock or share price of the company and the earning per share. It is very much helpful for the investors as they will be more interested in knowing the profitability of the shares of the company and how much profitable it will be in future. A PE ratio or profit earning ratio is equal to market value per share upon earning per share. It shows if the company's stock is overvalued or undervalued. Next ratio after this is activity ratio. Activity ratio are used to determine the efficiency of the organization in utilizing its asset for generating cash and revenue. It is used to check the level of investment made on an asset and the revenue that is generated. Say for instance, the activity ratio is also known as efficiency ratio, the more popular turnover ratio. There are few type of activity ratio which companies calculate, like stock turnover ratio, or the other name is inventory turnover ratio. Next, debtor turnover ratio or account receivable turnover ratio. Next, creditor turnover ratio or account payable turnover ratio. Next, working capital turnover ratio. Next, investment turnover ratio. So we'll discuss these ratios one by one. First is stock turnover ratio. This is one of the most important turnover ratio which highlights the relationship between inventory or stock in the business, cost of goods sold. It shows how fast the inventory get cleared in an accounting period, or in the other hand, number of times the inventory or the stock gets sold or consumed. For this reason, it is also known as inventory turnover ratio. And the formula of stock turnover ratio is cost of goods sold upon average inventory. Next ratio is debtor turnover ratio. This ratio is an important indicator of the company which shows how well the company is able to provide credit facilities to its customer, and at the same time it also able to recover the due amount within the payment period. It is also known as accounting receivable turnover ratio. Next is debtor turnover ratio. The formula is credit sales upon average debtor. It means the higher ratio indicates that credit policy of the company is sound, while the lower ratio shows that weak credit policy. Next, creditor turnover ratio. Creditor turnover ratio is measure of the capability of the company to pay off the amount of credit purchase successfully in the accounting period. It shows the number of time the account payable are cleared by the company in an accounting period. For this reason, it is also known as account payable turnover ratio. Creditor turnover ratio is equal to net credit purchase upon average creditor. The higher ratio is indicative that the company is able to finance all the credit purchase and vice versa. Next, working capital turnover ratio. This ratio is helpful in determining the effectiveness with which a company is able to utilize its working capital for generating sales of its goods. Working capital turnover ratio is equal to cost of goods sold upon working capital. It means if the company has the higher level of working capital, it shows that the working capital of the business is utilized properly. On the other hand, low working capital ratio suggested that business has too many debtors and inventory is unused. Next is net asset turnover ratio or investment turnover ratio. It relates to the sales taken place in the business and net asset or the capital employed. It determines the ability of the business to generate sales revenue by the use of net asset of the business. This ratio is calculated by this formula: net sales upon capital employed. So these are some of the important ratio which is used to calculate various activities or various work of the organization. It helps in comparison. It helps in checking which investment proposal is best. It helps in checking the financial soundness, marketable securities, and every financial aspect of the organization. So ratio analysis plays a very important role, and it is very important part of financial management. Thank you so much.